All right. Hey guys, Craig Beggins here. I'm the broker for C21 Beggins doing my buyer question series. So I've asked my agents to give me questions that buyers have that I can just record, that they can watch and they can share, whatever they want to do. So question today is, what makes up a mortgage payment? You know, we take it for granted that everybody knows what we're talking about, but they don't, right? So a mortgage payment is made up of principal, interest, taxes, insurance, and homeowners association dues, if there are any, right? So my house that I'm living in here, I have a principal payment, I have an interest payment, I have taxes, and I have insurance. Now, most lenders will require buyers to escrow the taxes and the insurance, which means they're going to take a portion of your payment and put it into an escrow account. So when the tax bill and the insurance bill comes due, they've got money in your escrow account, which is different than the escrow for buying a house. That's the down payment or the earnest money deposit on the purchase contract. I'm talking about an escrow account that actually holds your money. So when the tax bill comes in, it goes to the lender and the lender pays the tax bill. When the insurance bill comes in, it goes to the lender or the servicer and they pay the insurance bill. So most loans escrow taxes and insurance, right? So principal is the amount of money that pays down the loan. Interest is the cost of that money that you borrowed. Taxes are the cost of living in where your house is. The insurance is what protects your house in the event of catastrophe. So PITI and HOAs are HOAs. So that being said, I just lost my thought. Oh, that was my point. So some lenders don't require the escrow of taxes and insurance, which is risky. If you're not a high income earner or you don't have a substantial amount of cash in the bank, it can really be a problem when your tax bill comes in at the end of the year and it's $8,000 and you don't have $8,000 in your checking account, and then you get in trouble. Now, you'll never get in trouble because the bank will pay your taxes because they're a first lien position. They're going to protect their rights, but they're going to take your house from you if you don't catch it up. So the safer bet is to escrow your taxes and your insurance and get that one payment. So let's say that when I do my mortgage calculator, let's say I do a $250,000 loan at 6.5% interest, it'll give me a PI payment, principal and interest. Great, it's only $1,700 a month. But I got to add in my taxes and my insurance because that is a monthly cost unless I have the cash to pay it at bulk at the end of the year. So PITI and then my HOA dues. That's where the payments come in to make up what you get. So I hope that makes sense. That's kind of a short one. Principal, interest, taxes, insurance, and homeowners association dues. And that's what you have to qualify on. So we talked about ratios in a couple classes ago, but my debt to income ratio is going to include all those, PITI and homeowners association. So let's say PI is $1,700 a month and my TIH is going to be another $600 a month. Well, that's $2,300. So I got to qualify for my house income is $2,300 a month. And that can only be, say, typically it's 42%. 38, 42, I think is what it is, usually 44. So if I got a $10,000 house payment, $10,000 gross monthly income, I can have a $4,400 mortgage. All right, that's kind of what that means. But my other debts can't equal more than 33% to get it all done because I have to buy groceries, dry cleaning, and gas for my car, right? They want to make sure you're not squeezing yourself being house poor, right? So that's kind of how it works. So principal, interest, taxes, insurance, and homeowners association fees becomes your gross expense for the home. And that goes into your ratios to qualify for how much home you can actually afford to buy based on your provable income. Unless we have a special program because you're self-employed and we get different things like that. So that's it. Principal, interest, taxes, insurance, and homeowners fees are what comprise your mortgage payment.